$1 trillion. That is the silent number now haunting Wall Street, not because of a war, not because of a pandemic, but because Canada just pulled the plug. This week, Canada's largest banks, institutions that quietly bankroll America's real economy, began tightening credit and withdrawing billions of dollars from U.S. commercial real estate and small business lending.
Pressure is building. The top Canadian banks said, "Nah, we are done with this net zero UN BS." Yes, TD, CIBC, BMO all said bye-bye to Carney's UN banking initiative, trying to get all of the world's banks on the same page of fighting climate change.
Happening now, financial markets are closely watching developments after Canada confirmed a broad review of where its major pools of capital are invested, including significant exposure to banks and financial institutions in the United States. The announcement has triggered sharp reactions across Wall Street, sparked debate among investors, and raised questions about what this shift could mean for cross-border financial stability. Here are the confirmed facts first. Canada manages some of the largest institutional investment funds in the world. These include pension funds, public investment vehicles, and sovereign-style capital pools that collectively control trillions of dollars. For decades, a substantial portion of this money has been invested in U.S. financial markets, including major banks, bonds, equities, and infrastructure-linked assets. Canadian officials have now acknowledged that a strategic reassessment is underway. This reassessment focuses on risk exposure, long-term returns, and geopolitical uncertainty. As part of this process, some Canadian capital is being reduced, reallocated, or paused in certain U.S.-based financial institutions while alternative destinations are evaluated. This is not a full withdrawal, and it is not an emergency action. It is a managed review that has nonetheless sent a strong signal. Markets reacted quickly. Shares of several large U.S. banks experienced increased volatility as traders attempted to price in the potential scale of capital movement. Bond yields also showed mild fluctuations as investors considered whether foreign institutional demand might soften, while no single institution has reported a sudden liquidity crisis. Sentiment has clearly shifted. Canada's explanation centers on diversification and risk management. Global financial conditions have become more complex, with higher interest rates, rising debt levels, and growing geopolitical uncertainty. Canadian investment managers have stated that concentrating too much capital in one country, even a close partner, carries long-term risk. Rebalancing portfolios is presented as a precaution, not a confrontation. From the U.S. side, regulators and financial leaders have emphasized that American banks remain well capitalized and resilient. They point to strong balance sheets, regulatory safeguards, and ongoing domestic investment. At the same time, they acknowledge that foreign institutional capital plays an important role in maintaining market depth and confidence. Analysts warn that perception matters as much as numbers. Even modest capital adjustments can have outsized psychological effects if they are interpreted as a loss of confidence. Wall Street is highly sensitive to signals from large, disciplined investors. When those investors change direction, others pay attention. This could mean that more than money is moving. It could mean expectations are shifting. Canada's review may encourage other large funds around the world to re-examine their own exposure to U.S. financial institutions, not because of immediate danger, but because global risk calculations are evolving. The timing is important. Financial markets are already dealing with uncertainty around interest rates, commercial real estate exposure, and global growth prospects. When a major investor signals caution, it adds another layer to an already fragile environment. Canada's capital does not disappear when it leaves one market. It moves elsewhere. Some funds are reportedly being redirected toward domestic projects, including infrastructure, housing finance, and energy transition investments. Other portions are being evaluated for deployment in Europe and parts of Asia, where diversification opportunities are expanding. This shift reflects a broader trend. Large institutional investors are increasingly prioritizing stability, long-term predictability, and political risk alongside traditional financial metrics. Returns alone are no longer the only measure. Reliability and resilience matter just as much. For the United States, the immediate impact may be limited. U.S. financial markets are deep and liquid, capable of absorbing adjustments from even large foreign investors. However, analysts warn that repeated signals of caution from allies could slowly raise funding costs and reduce foreign participation over time. Banks feel this pressure differently than other sectors. They rely heavily on confidence. Depositors, bondholders, and shareholders all watch each other's behavior closely. When one major investor steps back, even for technical reasons, it can influence broader sentiment. This could mean U.S. banks become more reliant on domestic capital, or offer more attractive terms to retain international investors. Either outcome reshapes the competitive landscape. Canada's move also has political implications, even if it is framed as technical. Financial flows are a form of influence. They reflect trust, alignment, and long-term expectations. When capital shifts, relationships are quietly recalibrated. At the same time, it is important not to exaggerate. Canada and the United States remain deeply financially intertwined. Trade, investment, and banking links remain vast. A review and partial reallocation does not signal a rupture. It signals caution. Public reaction has been mixed. Some observers see the move as prudent risk management in an unstable world. Others view it as a warning sign about confidence in U.S. financial leadership. The truth likely sits somewhere in between. The broader question is why this moment feels different. Part of the answer lies in accumulation. Years of economic shocks, from pandemics to supply disruptions, have changed how institutions think about safety. Add rising global tension, and conservative strategies gain appeal. Another factor is domestic pressure. Canadian institutions face accountability to citizens whose pensions and savings depend on steady returns. Protecting those funds sometimes means making unpopular or unsettling decisions abroad. For Wall Street, the challenge will be communication. Maintaining transparency, stability, and predictability becomes even more important when external investors are reassessing risk. Confidence is not lost overnight, but it must be actively maintained. This could mean stronger disclosure, clearer regulatory signals, and efforts to reassure long-term partners. Financial leadership today requires not just strength but trust. Looking ahead, markets will watch closely to see whether this reallocation accelerates or stabilizes. If it remains limited, the story may fade into routine portfolio management. If it expands, it could mark a turning point in how global capital views U.S. financial dominance. What is clear is that capital is no longer passive. It moves strategically, guided by long-term thinking rather than short-term headlines. Countries that attract it must offer not just returns, but confidence in the future. As this situation develops, one thoughtful question remains for viewers. In a world where even close financial partners are rethinking exposure, how can global markets rebuild trust while adapting to a more cautious era of investment? The longer-term consequences of this financial shift are now becoming the focus of intense discussion among economists, regulators, and global investors. While the initial reaction centered on market volatility, the deeper issue is how trust, alignment, and strategy are evolving between two of the world's most closely connected financial systems. One of the first areas under scrutiny is pension security. Canadian pension funds are among the largest and most sophisticated globally, responsible for safeguarding retirement income for millions of people. Their investment decisions tend to be conservative, data-driven, and long-term. When these funds adjust exposure, it sends a signal that risk calculations have changed. Analysts warn that such moves are rarely impulsive and often reflect months or even years of internal review. This could mean concerns extend beyond short-term market cycles. Factors such as regulatory stability, debt sustainability, and political predictability increasingly shape investment decisions. Even small uncertainties, when combined, can tip the balance toward diversification. For U.S. financial institutions, the challenge is not an immediate shortage of capital, but a gradual shift in perception. International investors help anchor confidence, especially during periods of stress. If foreign capital becomes more selective, banks may face higher funding costs over time. These costs can be passed along through lending rates, affecting businesses and consumers alike. Another implication involves currency dynamics. Large cross-border capital flows influence exchange rates. If Canadian funds reduce exposure to U.S. assets and convert holdings elsewhere, even gradually, it can place subtle pressure on currency markets. While such effects are often muted, analysts warn that cumulative movements can matter. Domestic investment priorities in Canada are also reshaping the narrative. Redirecting capital toward housing, infrastructure, and energy projects at home aligns with public expectations. Citizens often prefer that national savings support visible domestic needs. This could mean political support for continued reallocation, even if returns abroad remain competitive. However, concentrating too much capital domestically carries its own risks. Overexposure to one economy can amplify downturns. Canadian investment managers are therefore walking a careful line between national development and global diversification. From a global perspective, other countries are watching closely. Large sovereign and pension funds in Europe, Asia, and the Middle East constantly benchmark against peers. When one major player adjusts strategy, others reassess their own assumptions. Analysts warn this can create a ripple effect, not through imitation, but through shared caution. This raises questions about the future structure of global finance. For decades, U.S. markets have been the default destination for excess capital. Depth, liquidity, and perceived safety made them unmatched. If that assumption is even slightly weakened, alternative financial centers gain relative appeal. Europe has been strengthening regulatory frameworks to attract long-term investors. Parts of Asia are expanding capital markets and offering incentives for institutional participation. This could mean competition for global capital is intensifying in ways not seen before. For the United States, maintaining leadership will require more than size. Stability, transparency, and policy consistency become decisive factors. Analysts warn that sudden shifts in regulation or fiscal direction can unsettle even loyal investors. The banking sector also faces structural changes. Digital finance, non-bank lending, and decentralized platforms are altering how capital moves. Traditional banks must adapt while preserving trust. When foreign investors reassess exposure, it adds urgency to this transformation. Public communication remains critical. When capital movements are misunderstood, they can fuel fear or nationalism. Clear explanations help prevent misinterpretation. Financial decisions framed as technical risk management should not be allowed to morph into political confrontation. Trade relationships may also feel indirect effects. Financial ties often reinforce commercial ones. If investment flows cool, trade financing and cross-border projects can become more expensive. This could mean businesses on both sides face higher costs, even without changes to tariffs or trade rules. At the same time, cooperation mechanisms remain strong. Regulatory dialogue, shared standards, and crisis coordination continue between Canada and the United States. These structures reduce the risk of sudden disruption and support gradual adjustment rather than shock. Households rarely see these processes directly, but they feel outcomes through interest rates, loan availability, and retirement returns. When institutional capital shifts, it eventually touches everyday life. Analysts warn that public awareness of these links remains low, making reactions more emotional when effects appear. Another layer is geopolitical alignment. Financial exposure often reflects broader trust. When countries feel aligned on global priorities, capital flows more freely. When alignment becomes uncertain, diversification follows. This does not imply hostility, but it does signal recalibration. Canada's move fits within a global trend of hedging. Rather than betting heavily on one outcome, institutions spread risk across regions and asset classes. This approach sacrifices some upside for greater security. In an uncertain world, that trade-off is increasingly attractive. For Wall Street, adaptation may involve courting a broader base of international investors and reinforcing long-term partnerships. Emphasizing stability over short-term gains could help retain confidence. Technology and data analytics will shape future decisions. Investors now monitor risks in real time, incorporating political, environmental, and social factors alongside financial metrics. This could mean capital becomes more responsive and less forgiving of ambiguity. Despite the attention, it is important to keep scale in perspective. The United States remains a central pillar of global finance. A partial reallocation by one partner does not erase decades of integration. Analysts warn against interpreting caution as collapse. What may change is complacency. Assumptions that capital will always flow automatically are being challenged. Trust must be earned continuously through performance and predictability. As markets digest these developments, volatility may settle, but questions will remain. How much diversification is enough? How much concentration is too risky? And how should nations balance domestic priorities with global opportunity? The answers will shape financial strategies for years to come. Capital, once anchored by habit, is now guided by adaptability. As viewers consider this evolving story, one thoughtful question remains. In an era where even trusted financial relationships are being reassessed, what does true stability look like for the global economy moving forward?